Good morning, everyone. My name is Michael Nolan, a partner in Grant Thornton in Cork, and welcome to our third in our practitioners series. Obviously, still continuing to do it virtually, which unfortunately is still the case, but there seems to be a bit of hope out there, and we are still on track, we think, for having this as a physical event later in the year. This morning, we're going to run through business readiness for sale, both from a tax and corporate finance perspective. Obviously, the economy has continued to on a very good trajectory, other than obviously the challenge areas in the hospitality, leisure, but other businesses have continued as normal, and we've seen an awful lot of M&A in the last few months and last few years, which is continuing to ramp up. One of the issues that we're finding in relation to M&A is that for readiness for sale, people, while they think they're prepared, they're not really prepared. What we've done an awful lot of work with people with clients in the last few months and last few years is actually prepping for sale, both from a structuring perspective and from an operational perspective. This morning, we're going to run through this. It's far more positive than we've run through in previous practitioners series, where we've gone on the insolvency and the examinership track. This is more about getting people ready for sale, both from a tax and corporate finance perspective. Dara Kelly, who's corporate finance partner based out of Limerick, but part of our national service line, is going to do 25 minutes in relation to his corporate finance case studies. They're doing a lot of work, as I mentioned, but all sorts of different clients, from fintech to normal to small owner managed to large owner managed. There's been an awful lot of transactions in the last few months. He's going to just run through a few case studies in relation to readiness for sale. Similarly, Brian Cronin, who's an associate director in our tax group here in Cork, is going to run through the tax structuring in advance of any sale. Obviously, with all sorts of things like retirement relief, entrepreneur relief, participating holding companies, there's a number of different structures and plans that people can put in place in advance of a sale to minimize the tax, the CGT, or to eliminate the CGT. Brian probably kill me for saying eliminate, but to bring it down to a more manageable level and to make it far more tax efficient. So Brian will follow Dara in relation to Dara's conversation in relation to and presentation in relation to corporate finance. So Dara, I'll hand over to you. I hope I've introduced you correctly, and I'll let you loose on the corporate finance side. Thank you.
I think Dara just got cut off there, so we might just go on to Brian, maybe.
Yeah, sorry, we've had some technical difficulties. We'll switch over. We'll do it in reverse. Brian,
okay.
we'll do the tax structuring.
No problem. Okay, good morning, everybody. As Mick introduced me, my name is Brian Cronin. I'm an associate tax director in Grant Thornton. I've just been here for the last number of years, but I've been practicing in the area of transaction structuring and advisory for over 20 years. We'll just leave it at that. You might just pass on to the next slide there, Valerie. Okay, so this morning I'm going to talk about a number of areas. Obviously, the number of tax considerations that can come into play in relation to the disposals of companies are very broad. But what I wanted to do this morning was just run through a number of areas where, in practice, we've seen clients meeting particular challenges. And usually it's always in the context of you've had a very successful business. There's been an awful lot of, understandably, the owners have concentrated on building value in the business. They now have, sometimes unexpectedly, a very lucrative offer to sell. And suddenly they're confronted with, well, my God, there's a very substantial tax bill associated with this. And it's at that stage they turn around and say, well, what can you do about that? And while, you know, there is things that you can do if a sale turns up tomorrow, it's also much easier to do it if you're doing it well in advance. So as I say, just going to run through a number of areas. You can actually just go back to the previous one that I'd say for the moment, Valerie. The first one is around opportunities and pitfalls. And really, I suppose that everything here is that we go through is an opportunity or a pitfall. but I just want to bring very specific ones into account there. The second is just around maximization of reliefs. The third then will be what is actually an increasingly an issue over the last even 18 months is treatment of cash in companies, both because the revenue have focused on it more, and a lot of companies have actually found themselves going through the COVID crisis becoming quite cash rich because probably there isn't the opportunity to make investments so much. Costs have decreased, and sometimes the profits have even gone up. And the last area they're just going to cover is disposals by non-residents. So this could relate both to people who are thinking about retiring abroad and maybe are going to dispose of assets at that stage, or people who have never lived in Ireland but just have investments here. So if you want to go on to the next slide there, Valerie. So as I say, we tried to build this around particular case studies. So in this case, we have Mary is a serial entrepreneur. So this obviously isn't her first investment. In 2016, she established a software company with, initial share capital of $500,000. She probably got some advice at the time, as we'll talk through. So the company is 100% subsidiary of a holding company in which Mary is also the shareholder. So then, as sometimes is the case with these, startup software companies, just a few years down the line, she's got an offer to sell for $5 million, but also an earnout of 25% of equal to 25% of EBITDA for the next 5 years. So the way this would be structured is literally that there'd be an upfront payment of $5 million, and then whether in stages or at the end of, probably in stages, she will get further payments in respect of her shares calculated by this uncertain amount, which is the amount that the company is going to make in each year over the next 5 years. So if you want to go on to the next slide there, Valerie. So the big advantage that Valerie has here is that she holds her shares in the trading company through a holding company. Given that she did this, she probably got advice at the start that she should avail of, should hold at least some of her shares through a holding company. A lot of the time, what people do is, if they're setting up a company, or what they should do is, if they haven't availed of entrepreneur relief previously, hold some of the shares in their own name and so hold some through a holding company, which will mean that on an eventual sale, they'll be able to get some of the cash into their own hands, paying only 10% tax on it, and the rest will go into the holding company. Now, the participation exemption, which applies on disposals by holding companies, means that no capital gains tax will arise on a disposal by a corporate shareholder of shares in a trading company, provided they have held at least a 5% shareholding for the last 12 months. And in Mary's case, that's going to be the case. So it would seem that she's going to be able to get a tax-free gain on the $5 million going into her holding company. She's a serial entrepreneur, so the gross proceeds are then going to be available to fund her next acquisition or her next venture. What we often find is people, when they're confronted by a sale, they then want to implement a holding company structure at that point. That obviously gives rise to the very obvious commercial point of view that the share, you're going to have to hold the shares for 12 months prior to a disposal. And even with the lengthy due diligence, negotiating SPAs, etc., the share purchase, the purchaser may not be willing to wait for that long. Now, you could adopt a strategy where you sell them maybe a percentage of the shares upfront and then hold on to the rest until a holding company has held them for 12 months. But you're going to have commercial difficulties with that. There's also a tax challenge in terms of implementing a holding company structure just in advance of a sale. Number one, if you're not taking over 100% of the shares, or even 90% of the shares in the trading company, you're likely to have a stamp duty cost. You're then trying to implement a reorganization to insert a holding company, possibly just weeks before an actual sale. In order to do that kind of a reorganization, you have to pass a bona fide commercial test, bona fide test that this is for commercial reasons and not as part of a scheme to avoid tax. Now, there are arguments that that is the case, but it's going to be a lot more difficult in the context of an immediate sale. And another issue, by the way, that can come up here that people sometimes forget in relation to the participation exemption is that it doesn't apply where a sale, where the company derives the majority of its value from Irish land and buildings. So again, here, for instance, in Mary's case, she has a software company, but so, say at the outset, they'd acquired a property to trade from, and just because the area that it was in, etc., the value of that had gone up significantly over the time that she held it. You know, it may prove difficult to show that the software company doesn't derive its value from these land and buildings, which, even though they're trading assets, so they don't need to be investment assets. Simply the fact that they're Irish land and buildings will bring them out of the participation exemption. So I suppose that's just some of the reasons there why it's important that Mary did put the holding company in early. And we just go on to the next slide to show. So she's taken advantage of the opportunity to avail of the participation exemption. But given the actual commercial terms that she's negotiated, will she get participation exemption on the entire proceeds? In this case, arguably not. While there isn't a specific legislative position in relation to it, the case of Marin and Ingalls may apply, because her the consideration for the sale is 5 million plus an uncertain future sum equal to the EBIT, 25% of the EBITDA over the next 5 years. So the earnout payment is in respect of is now the future 5 payments that she's going to receive are now arguably, based on the case of Marin and Ingalls, not payments for the shares which she has disposed of, but payments in respect of a right which she acquired in consideration of the disposal of the shares. And any payment that she gets now is a payment in respect of that right rather than a payment for the shares. What difference does that make? Well, the participation exemption only applies to a sale of shares. So arguably, the earnout payments that Mary is going to get in the future won't avail of the participation exemption. She also has the problem that she now has to, on the creation of this right, she now has to estimate how much tax she will pay in the future, and so in order to avoid being subject to interest payments, she'll have to estimate that. If she doesn't get as much as she estimated, rather than going back and making a claim for the repayment of capital gains tax, she will realize a loss in respect of the right, being the right to receive a future lump sum. So she could end up, number one, not getting the participation exemption. Number two, having to pay capital gains tax on that amount up front. And number three, if she doesn't receive the full amount of the estimated consideration, being stuck with a loss inside the holding company, which she may never actually be able to use in the future. So even though she's done a lot of planning, the actual terms of the share purchase agreement have tripped her up. Might go on to the next slide there, Valerie. So one possible solution in relation to this is to get out of the application of Marin v. Ingalls. And that would happen as long as you say that the consideration isn't wholly uncertain. And you could do that by putting a cap on the EBITDA, that the EBITDA figure that will be used for the share purchase agreement. You could put in an wholly unrealistically high amount so that you're never actually going to lose out commercially. That should mean that it doesn't then matter how much you estimate that you're going to get in the future, because the participation exemption applies, you have no tax. However, that would work in the current instance because Mary is the only shareholder. But if you're trying to negotiate that, the application of that to other shareholders, some of whom may not be able to get the participation exemption, that could be commercially problematic. Okay, can you go on to the next slide, Valerie? Thanks very much. A lot of people, I suppose, will be aware that on a future sale, they're going to be able to avail of particular reliefs. People will be familiar with the participation exemption, which we've already spoken about. Entrepreneur relief, which allows you to get 10%, pay only 10% tax on the first million of gains, and retirement relief, which allows you to, between ages 55 and 66, to transfer any amount of property to your children tax-free, and to transfer up to 750,000 of a property to a stranger to sell it and pay zero tax on it. There's a general truism that you can't avail of all of these reliefs, but actually, if you have a cooperative purchaser and you structure things efficiently going into it, you may actually be able to do so. So in this case, we're looking at John, who owns a manufacturing company. He's getting up to age 54, so he's going to be able to avail of entrepreneur relief next year. But and he's selling to his niece, so we can assume that there is at least some degree of cooperation going to be available there. So a lot of people would say you can't get retirement relief and entrepreneur relief because they're both effectively going to apply to the same gains. And retirement relief, once you go over the 750,000, you start to lose the retirement relief. It's effectively clawed back. However, in the current instance, say John sells some of his shares to his niece before he turns 55, he can claim entrepreneur relief on that. After he turns 55, he can make a further disposal and claim retirement relief. Now, when you aggregate the disposals for retirement relief, you only aggregate qualifying disposals. So because his previous disposal to his niece was at a time when he wouldn't have qualified for retirement relief, that amount isn't aggregated. So I think if you structure things properly, you may be able to solve the two of them or claim the two of them. And if he's a holding company in place for some of his shares, he may be also able to claim that. So, again, prior planning, and obviously in this case, a cooperative purchaser can allow you make avail of more than one of the reliefs. Do you want to go on to the next one there, Valerie? Yes, thanks. Again, as with everything, there's always a possible pitfall. This one was introduced by, I think it was Finance Act 2017, it might have been 2016. Section 135(3)A of the Taxes Consolidation Act effectively denies the vendor a capital gains tax treatment where there's been an arrangement between himself and the purchaser to allow the financing of the purchase to utilize the funds that are in the company. This was often done before, where a child would set up a company to purchase shares from their parents. Most of the shares would already be transferred to them, and then once the retirement relief amount was left, the children would buy those shares with their new company. There'd be no money in the new company to finance the shareholding, but they'd then take a dividend from the target company to actually pay the consideration. So that was a way of getting around the rules in relation to redemptions of shares in companies availing of CGT. So this legislation was brought in. Now, it's extremely broadly drafted. Revenue have put guidance around it that circumscribes it to a significant extent. However, in a case like this, where there's another family member, albeit not a child, is acquiring the shares in the company, you need to be very careful that Section 135(3)A doesn't apply, because if it does, the gain by the seller will be treated as an income distribution rather than capital gains. So not alone do you have a higher rate of tax, but all your reliefs in relation to retirement relief, entrepreneur relief, etc., fall away. So it's very careful that you need to be very careful in this kind of instance that there is no arrangement in place that the target company does not in any way prior to a sale assist the acquiring company in getting finance, because it'll probably be necessary now for the outside company to get bank finance. They'll need to arrange that themselves. Any cooperation from the target company could let you fall of 135(3)A. Move on to the next one, Valerie. So the next area is just in relation to access, cash in companies. Again, we're looking at a very successful company here, which has built up significant cash reserves over the years. And Tom is now looking to transfer the shares in the company onto his children. Move on to the next one there, Valerie, please. So there are a number of challenges here, particularly in relation to claiming business relief on a transfer to the children. Under section 100 subsection 2 of the Capital Acquisitions Tax Act, assets of a business will not, assets in a company will not qualify for business relief unless they have been used for the purposes of the business for the previous 2 years. The danger here, and it's something that Revenue, I've seen them focus on laser-like attention on over the last number of years, is to say that, well, if there's excess cash more than is required for the working capital of the business in the company, well, that is not an asset that is required for the carrying on of the business. Effectively treat it as an investment and reduce the percentage of business relief applying to the company on the same basis. An extreme situation can arise under section 93 of the Capital Acquisitions Tax Act, where because there's so much cash in the company that the revenue could, and I haven't seen them take this particular line, but that's probably because it doesn't come up factually on that many occasions, but it's still something to watch out for, where there's so much cash in the company that Revenue turn around and say, okay, it's not that we're simply going to disallow you the value of the company that derives from the cash. They take the viewpoint that this is no longer a company whose business consists, or sorry, it has now become a company whose business consists wholly or mainly of the holding of investments, in which case business relief could be entirely denied. There's a similar consideration for entrepreneur relief. A qualifying business means a business other than the holding of securities or other assets as investments. Now, both in relation to section 93 and in relation to entrepreneur relief, I would argue that the simple holding of cash in a current account is not the carrying on of the business. On the other hand, I think even in these days of negative interest rates, holding cash in a deposit account could be regarded as the carrying on of a business. Either way, it's probably not an argument you want to get into with Revenue. So if we just move on to the next slide, we look at ways that the amount of cash that you're holding in the company could be reduced prior to a sale or a transfer to children. The important thing to notice in relation to those is, they're point in time tests. So even very close to the actual disposal date, you can reorganize your affairs so that as at the date of the actual transfer, you don't have the same sort of problem. One is simply to make out your arguments that the level of working capital in the business is higher than might be supposed. What I have seen happen though is Revenue come back years later and say, well, in fact, the cash pile in the company went pretty much untouched for 3 or 4 years afterwards. Therefore, it can't have been required for working capital. Where you have a holding company, you can pay dividends up into that, but you should be aware that there is anti-avoidance legislation there where there's effectively depreciatory dividends take place well before a sale or just before a sale, the value that was moved out of the company can still be subject to CGT. So if you are following that sort of a policy, you should have a regular dividend policy to siphon funds out of the company built over a number of years, because the anti-avoidance legislation only applies to special dividends. There may be an opportunity to backfund an occupational pension scheme. There may be an opportunity to pay termination payments to directors or other family members employed in the business. And you could do a pre-sale reorganization, just moving all the trading assets into a new company controlled by the shareholders and leaving some of the cash behind. But you have the same sort of challenges there that you would have in implementing a holding company structure prior to a sale, in that revenue may challenge the bona fide requirement in relation to implementing the holding company structure. So you might just go on to, I think, what is the last number of slides there. So this is disposals by non-residents. In this case, we have a hardworking businessman who has built up significant reserves in his company over many years. He's decided that he wants to retire and move to Portugal, but the company is still trading. He still has significant shareholding in it, and he's considering making disposals of those shares after he's left the country. Next one, Valerie. So just a number of issues here. I mean, I suppose the opportunity here is that on the basis that the company doesn't derive its value from Irish land and buildings, once he has ceased to become resident and ordinarily resident, then he should cease to be taxable in Ireland. There's another opportunity for non-domiciled individuals in terms of availing of the remittance basis. And if he's moved to Portugal, for instance, my understanding of the capital gains tax regime over there may have changed, is that you're only taxed on the gain which has arisen after you've become resident in the country. So the gains that have arisen all through his lifetime in Ireland won't be taxed in Ireland and won't be taxed in Portugal. Now, a lot of people were availing of this type of structure. So about 10 years ago, yes, possibly more, 15 years ago, Section 29A was brought in, which effectively seeks to continue to tax gains made by individuals who have left the country, have ceased to be resident or ordinarily resident, where they make significant disposals of, usually you have to have 5% of a company and it has to be worth over €500,000. This operates by saying that if you leave the country, make such a disposal, and then return to the country within 5 years, they will treat you as having made a disposal at the time that you left Ireland. Now, there's significant questions as to whether, or there were significant questions as to whether this was compatible with tax treaties, and a lot of people moved particularly to Austria, on the basis that the Ireland-Austria tax treaty overruled Section 29A. However, with the developments on an international scale in relation to BEPS, there have been now changes to a lot of Ireland's double tax agreements, which basically say that if you've moved to another jurisdiction with the intention of utilizing the double taxation agreement in order to make tax-free or low tax gains by going there, you won't be able to avail of the tax treaty. So that's made it much more difficult for people to avail of that when they go abroad. Having said that, in this instance, if the taxpayer, or hopefully former taxpayer, can show that his reason for moving to Portugal is not to avail of their friendlier tax position, but that he wishes to go, he wants to play golf, he wants to enjoy the weather and the culture and the cuisine of Portugal, and stays over there, he's in a stronger position to utilize the tax treaty. And of course, if you do stay out of the country for 5 years, then that's it. You can even make the disposal during that 5-year period, but you can't return to Ireland within the 5 years. You probably need to be staying out 6 or 7. So there's still significant opportunities there for people who want to retire abroad. The important thing, of course, is to select the right country to go to that has a friendlier tax regime. So that's just my run through of some of the opportunities and pitfalls. Not sure if any questions have come in, but if they have, maybe we can deal with them at the end after Dara's also spoken.
Good morning, everybody. My apologies for some technical issues at the top of my presentation. The usual Murphy's Law. I have a very good connection, but it went down just at the start. So good morning to everyone. My name is Dara Kelly. I'm a partner in the corporate finance team a national team. I'm based in Limerick, but also spent time down in Cork as well, and also on the international side. So what I'd like to run through today is readiness for sale. As Mick said at the outset, we're seeing a lot of a real spike in M&A activity, really running now through for the last 24, 12 months. It was strange when it was in COVID. You were wondering what was happening. Why is the activity so strong? I think we came from a good place running into COVID. COVID obviously sent a lot of businesses sideways, but what it did throw up, and my rationale to it is that businesses that got through COVID, some overperforming through that 6-12 months, it's a real acid test. And if you're on the buy side, if you're a buyer looking at these businesses and you see them performing through COVID, it gives huge confidence to you, which we're seeing put upward pressure on prices. So I think that's feeding into some of the rationale. You also have, I suppose, the mindset of a business owner that has managed to get through COVID and maybe is now thinking of a little bit of, well, that was a very tough whatever period of time, and wants to put some cash aside. So wants to realize some of the value in their business, and whether that's all of it or some of it, we can talk about different nuances, but definitely those two factors. I think some owner managed businesses want to bank and get some take some value off the table for what they've been working hard on. Then you've got on the buy side, I think, a lot of private equity interest across the board in Ireland at the moment, but even a lot of trade players looking to grow and doing that through, can execute on that a lot quicker through M&A than organic. And they're looking at other businesses that have stood through COVID, and it's given them a lot of confidence on the buy side. So I definitely think those two things are factoring in. So what that throws up is two things. It's either an informal discussion that kicks off a sale process, or a formal process. Now, probably we can talk about both today, because if it's a formal process, it's a bit easier. We would probably very deliberately come in and look at readiness for sale, and this usually falls into what we call vendor due diligence, which is where the seller takes the role of providing the due diligence reports and analysis to the buyers, right? And what that allows a lot of control. It also allows any issues that come up to be considered, nice and a balanced consideration of all these items that could ultimately go to affect the price, and allows that process to be managed slightly more informal, and sometimes, I wouldn't say on the back foot, but a more accelerated situation is where you could have informal discussions happening between your client and a buyer, and they have gone down the road quite a bit, and some information has been shared, and then all of a sudden we're moving into legals, and items need to be now quantified, and these will ultimately be price adjusting items. So that sometimes you can find yourself on the back foot if a lot of information has been disclosed and you're trying to make an argument as to how different items should be treated. Now we go to the next slide. I have done just to try and keep this a practical session, I have done a bit of a case study next, but just on the basics of what you're looking at there. What if we do it under the banner of vendor due diligence, because that is essentially getting your business ready for sale, what are the items we need to be looking at? So first is the adjustment to profits. Like, the business more than likely going to be valued off a multiple of profits. We're seeing discounted cash flows being used just to get comfort on the multiple, but the multiple is still a multiple of profits is still the most basic way buyers will put offers to companies. So we need to consider, is there any adjustments that could go to that, to those profits? And we've got a slide at the back on that. Then very quickly, buyers are very interested in outturn. So what's the rest of the year going to look like? So like they're pricing off, you know, the last 12 months. Sometimes they price off forward-looking numbers, but it's more common to price off the last 12 months. But immediately they're thinking, well, what's the first 12 months, or what's the rest of the year going to look like when we're in control, or when we're in the shareholder position? And that's considering their own issues, like what kind of debt repayment ability is there, and dividend policies, and all that kind of thing. So again, we want to be able to be preloaded in what we think that looks like. Now, to do that, we need to just understand what drivers run our business. So there's, you know, whatever 5 or 6 different business drivers. But when we're putting forward what we think the rest of the business, the year trading will look like, what are we using to project that out? And again, this is all something you want to consider in advance of releasing information, because this is all the diligence process on the buy side now is what's going to, you know, really pull these assumptions apart. And that's where you can lose value. Obviously, with any set of projections or forecasts, we want to look at sensitivities to it and what potentially weaknesses we have in our assumptions. Again, to be preloaded for that challenge when it comes to us. Working capital, this is probably where we see the, you know, a lot of value either clawed back or lost. Sometimes it's really it's not considered early enough. So there is plus and minus adjustments to, you know, what a buyer will consider is the level of working capital they expect to be in the business when they take it up. If they get less, they will look for price deduction straight off the peg. Again, I've got some worked examples on that. So thinking about what is normalized working capital, like with family run businesses you know, there can be a lot of, say, non-trading-ish items flowing through the balance sheet. So we just want to make sure that we're confident we've scrubbed it for all of that and ready to respond to any questions. Then the rest of the balance sheet, really, this is debt and more subtle around provisions. So what kind of provisions are we carrying? Are they sufficient? Will, you know, the obvious one is provision against doubtful debts. Buyers will do a lot of diligence around that to try and figure out what's the an appropriate number, and we'll look at trends over a couple of years. So again, you know, knowing if we've had any exceptional bad debts, being able to call that out, remove that from the analysis, explain why it was exceptional if it was exceptional, and then argue a lower provision, all goes to ultimate value, which I'll see in the enterprise to equity value bridge now in a minute. And then accounting policies, we're seeing a shift on around the accounting for leases. So I think it's clearly, you know, so this is where you scrub out the rent cost and run it through the balance sheet and release it over the period of the lease to charge the P&L, but it falls out of the EBITDA calculation when it's accounted for like that. So now what we're seeing in the market is buyers are not tolerating that. They want a rental cost to hit the EBITDA, which I think is fair. But again, it's just the nuances around that is what accounting policies are you using in your business? What challenges could you have to it? You know, we've seen other recent policies that are getting challenged, like the capitalization of sales commission. So if you're motivating your sales team based on commission, there is a standard that you can capitalize that and release it. Again, we're seeing a very heavy pushback on that not being tolerated. The full commission cost is to be recognized in the year in which it was earned for the purposes of calculating you know, EBITDA or the profit that they're going to make an offer up based on. And then tax liabilities and risks. Again, very heavy diligence on that, and buyers will of course exaggerate any weaknesses in the tax diligence for a price chip or escrow accounts. You know, and Brian will obviously be the man you'd need to pull in on that. But again, you can see risk there. So there's like the overview. So when you're thinking readiness, that's the mindset to be thinking through those items. What do the work. So you're either going to do this work informally in a readiness, what we call readiness for sale, or else you formally do it through vendor due diligence documents. So if we just move to the next slide and start trying to put some numbers around. So what I thought would be useful as a short case study is to talk about the key metrics that make up ultimately the bottom line price that you get in your sale, and to understand the way that they can affect the ultimate consideration. So what we've done is an EBITDA to equity value bridge here. So this is the EBITDA is the adjusted number that a buyer will consider as your profit, your normal profit. And then we'll apply their multiple to that and to get to their enterprise value. And then there's plus and minus adjustments from enterprise value to equity value, which is what the check they actually write. Now, of course, there's various ways that they can pay the consideration. It can be all cash. They can look to try and ask you to roll the seller to roll some of their value into their company, so you end up as a shareholder in the buyer, and various other iterations in between. But if we just keep it nice and simple, that it's a straight sale, 100% sale. So the first thing to do is what is the adjusted EBITDA that we're going to agree is the number they need to apply their multiple to. So in this instance here, we had a couple of adjustments. I've included some more that we see very common in owner managed businesses. So if we just run down through a few of them just as examples, like recruitment fees, if you argue that that's a one-off event and you're not doing it every year, you would look to add back. And obviously as a seller, we're looking to add back as many costs as we can to get to this adjusted EBITDA number. And the buyer obviously is coming at it from the exact opposite position. They're looking to potentially normalize for any costs that we don't have, or strip out any profits or credits to the P&L that we've taken in that they don't think is fair. So COVID-19 wage support is a huge one now, right? So where a business continues to trade profitably, it's very little defense for you to keep the COVID wage support in. So in this instance here, you can see this business doubled its, pretty much doubled its revenues in FY20. There's absolutely no basis for a defense on the wage support, because profits went up, revenue went up, yet this is an artificial reduction in costs by having a wage support. Now, if revenue had not gone up here, which we see in obviously in lots of other businesses, it gets very subjective, but you do want to make the argument that if you're stripping out the wage support, you need to introduce, either profits or a reduction in costs into your calculation here. So you say, well, we were shut for 3 months, and if we look at the same profits we made in the same 3 months in the previous year, we're reintroducing those profits to balance out the wage support. Like that's the type of methodology. But you could spend a whole session on debating the different aspects of this, but the point being, it's a highly topical one. And when you're looking at stripping out the wage support, you need to consider, should you be bringing in loss of profits, staff rationalization that didn't happen because of the wage support, that type of thing, offsets to try and paint a fair picture. Again, just talking about family-run businesses, like it's very common to see various wages and salaries being run through a business, and car insurance, car costs, various other expenses that are not purely trade expenses. Now, that's a very common add back for family-run businesses. Really, the buyer is just looking at the pure profit, so that is not a negative to put that in. You obviously have to consider the tax consequences of it on the diligence side, but again, a very common one. Having the right level of staff costs is another one. So there's various line items here to touch on staff and personnel costs, but it's not uncommon for instance, owner-run businesses to have lower than normal salaries to themselves and potentially higher than normal pensions. So you need to consider that. You need to consider whether some of the management team is really excess and will be leaving as part of the sale and will not need to be replaced. So when you're knocking out costs, the principle is, do you need to reintroduce another cost for knocking out a cost? And if you can make the argument that you don't, well then, that's the basis of a legitimate add back. So a lot around staff adjustments, bonuses, which touch a number of places here. But again, are we properly accruing for bonuses? Do we expect bonuses to be normal? So that's another very common adjustment that we see. And then just to finish off, I had touched on the accounting, the various accounting. So in this particular example, they had taken the rental cost out of the EBITDA, and the buyer obviously said that that's not going to pass. That rental cost needs to be reintroduced because it's a pure cash cost. If you think it through, it's not the taking out of your EBITDA is just pure accounting, but the cash effect is the exact same. So that's what they will be focusing on. And to finish off on the bad debts normalization, again, fairly heavily debated, but just, try and go with something that's fair over the period and strip out any exceptionals. So you can see there's a huge opportunity to lose or get value there on the sell side. And the problem is a buyer is always going to do this. Sellers sometimes don't always prepare for this. And when the item is raised on the buy side and hasn't been considered on the sell side, you're usually at a disadvantage to make your argument back. So the net effect of all of these adjustments was only 10. That's just the way that the table is laid out. So now we take the adjusted EBITDA, right, and we bring in the adjustment, brings it slightly up, and then we apply the multiple. Now this was financial services business trading at very high multiples, so it was 15 in this example. You would not see that across the board, but high single digits now, no matter what industry you're talking about, is very normal. But financial services is way up in the double digits. So that got us to an enterprise value. So if we then think about, right, so that's our enterprise value, and we've got through diligence on the P&L, what's happening on the balance sheet that will affect ultimately the end price we get. So the baseline principle for any offer is no cash, no debt, and normal working capital. Okay, so we assume we're buying a business in its perfect normalized form without any cash, without any debt, and then we just plus or minus for that. So in this example, there was cash on balance sheet 1.6, so that just simply gets added. Okay, and now we need to consider debt, and again, it's what's the normalized debt or true debt position. More true debt is a better definition. So if you flick on to the next slide, you'll see what can happen here. So you start off with the basic debt of the business, that's clear, right? Now, things that come into this that throw people off are like, client deposits. So some people might argue, well, that's a working capital item, but a buyer is going to say, no, that's something that needs to be brought in when we're thinking about. Now, if you've got cash matching it, it actually, nets out. But sometimes you can have client deposits in, which is a liability, and you've lost it in the cash. Now, some other items we see here is corporation tax. That is a standard that we bring into debt. It's generally accepted that VAT and POA PSI are working capital items, assuming they are within terms, right? So it doesn't come into the debt. Because remember, debt's just coming straight off the price. It's just a minus. I will get to the working capital last. So other items now that a buyer will focus on is out of terms creditors. So you could have suppliers, but you've run up balances with them that have got out of terms. A buyer might say, well, look, that's actually turned into a loan because you're not staying up to terms, and we're treating that as debt. So we're taking that element of the balance out of your working capital and we're putting it into debt, and that's again coming straight off the price. Unpaid bonuses is another very common one. So the rationale here is if I have, as the seller, has generated profits, which the buyer is going to pay a multiple on those profits, and in those profits I've recognized the bonus I had to pay to my sales team to get them, but I didn't bother paying it. A buyer is not going to accept that. They'll say, well, you should have paid that, therefore your cash should be lower and it wouldn't be on your debt. So if you haven't paid it you essentially have the cash, of course, first, because your 1.6 is still your 1.6, but they will bring in the accrued bonuses out of working capital into debt, and that will come straight off the price. I've included deferred income here. Again, you could do a whole session on deferred income, one of the most heavily negotiated working capital adjustments. So this is where you've taken, obviously, cash. Well, so there's two ways to look at deferred income. You could just have raised the invoice and haven't provided the service, so it's deferred income. And the other side of it is sitting in your receivables, right? So from a working capital perspective, you could argue that nets off to zero. But where the receivable is then subsequently collected in advance of you providing the service. So now what you have is you've cash, which you're adding onto the price, and you've got an element of your deferred income, which is not backed up by a receivable. A buyer will come very hard at that to say that's debt, because you've actually taken the cash off your client. You're looking to add the cash onto the price. They will look to strip out that element of deferred revenue and minus it off the price through debt, which gets to a net neutral position for them. So it really comes down to negotiation, but there is certain industries where it is just, there's precedent, it's accepted whether deferred income is working capital or not, you know, and you really got to get into the detail, like you know, are the advance payable, the advance amounts repayable if the service is cancelled halfway through, you know, things like that. So one of the most heavily debated items in working capital. I touched on deposits, advance payments, touched on corporation tax, and then anything that falls out of DD. So you could potentially be bringing in tax estimates that are not on your balance sheet to start off with, because either you prepping for sale threw up something in due diligence, tax due diligence, or else the buyers are after finding something legitimate. And then lease finance and hires purchase. So this is where you're not buying your assets in cash, your fixed assets in cash, you're finance leasing them. Again, that's you holding cash but introducing liabilities. So they will look to deduct that. Again, bring it to debt and deduct it off, essentially net it against the cash. So if we go to the last slide, then pulls everything together. This is then taking your working capital as your last item in the plus or minus to get to the bottom line price. So this is the concept of normalized working capital. So if we're putting out a position as to what we think is normal. A buyer will then say, okay, well, we have to set a target that's, you know, that's acceptable to both of us based on a normalized working capital. And this is where we do see a lot of value lost and won here. So this can mirror your debt. So for instance, if you had your legacy creditors in here, that's going to come out. Okay, so that'll reduce your creditors. You could have, you know, related party debt, accrued bonuses, your deferred income, deposits. All of these items, a change to your bad debt provisioning. And what you're basically doing is saying, okay, well, here is a fair normalized working capital. Now, you then need to set the peg, which is what it measures against. So this is a plus or minus type thing again. The negotiation of what the peg is, that's really where you're going with all the work you're doing on normalized working capital. Because as a seller, we're trying to set the peg as low as possible. So that makes it as easy for us to hit as possible. So in this particular example, we had negotiated the peg at 170K positive. So that's assets over liabilities. And that was based on a trailing 12-month normalized picture. So a lot of work goes into this. However, on the date of completion, you know, when you set the plus or minus, they only had working capital at a normalized level of 136. So they actually were below the peg. And that 34 grand then comes off the price. So again, a buyer will be looking to strip out as many liabilities of this as possible, any credits, because that pushes up the working capital, which pushes up the target that we have to hit as sellers, as in what assets we need to leave behind. So, so I think that's really, you know, the last piece then to get to the bottom line. So in this particular example, you can see they had an enterprise value of 17. They had cash, which they got credit for. They had to take debt items of 172, and they were low. They missed out on the peg by 34, and that then reduced the bottom number to 18.9 in this example. But I think the point on conclusion on this is the amount of movement and variables after the first discussion happens, that we always try and emphasize that to our clients, that just because, especially if they've started an informal discussion, that they've agreed 15 times your profits, and that sounds like a great offer. The amount of movement that can go on to nailing the final number throughout all that process, there's a large amount of variables there, and that's bringing us back to, are we ready for all of these discussions? Have we thought out our position on both our EBITDA, our working capital, and our debt-like items? And then obviously back up earlier in the presentation is the even wider options about just thinking right through start to finish, accounting policies, everything like that. So in conclusion, that's our piece on the readiness, and just trying to focus in on really where you can add value to your clients, and the plus and minus to get to the bottom line on the price. So I'll open it up to any questions.
There doesn't seem to be any questions in the chat box there. I think yourself and Brian's presentations were very comprehensive. They probably frightened some people because there's an awful lot to do to prep a business for sale nowadays, and there's an awful lot of points where arguments could be had, and I think you both went through them very well. We're coming right up to 11 o'clock there, so if there isn't any questions, I think we'll wrap it up. We will be distributing the slides to everybody that's on the call, and obviously don't hesitate to give us a shout if you do need any help in relation to any of this. We're open for business, very much so. We're doing a lot of this work at the moment, we're doing a lot of it with a lot of people that are actually on the call, so they're well aware of the services that we can give, but it is complex, it is tricky, it is an area that needs a lot of preparation. So look, you can see our expertise and our credentials in relation to it, and that's what we just wanted to show this morning. So look, thanks very much for dialing in this morning. I know it's a kind of bleak day here in I think it's a bleak day here in Cork, like it was like in the rest of the country, but have a great day. Stay safe. Thanks very much. Cheers, guys.